Bismillahirrahmanirrahim. Uh, uh, I would like to welcome you all the participants to the annual corporate briefing session of Systems Limited. Uh, on behalf of Insight Securities, I would like to welcome the management of Systems. We have with us Mr. Asif Peer, who is the CEO of the firm, Ms. Ruhi Khan, who is the Group CFO, and Mr. Tahir Saeed, who is the Chief Investment Officer at Systems Limited. Systems Limited has been a consistent buy with Insight Securities for the last 7 years. Uh, the company has performed remarkably well. It's one of the fastest growing top line growing companies at the PSX. The 5-year dollarized CAGR is north of 34%. Uh, the 5-year PKR CAGR is north of 59%. And we have witnessed tremendous growth, mainly in the Middle East over the last few years. We were computing the numbers on the Middle East side. The 5-year CAGR is approximately at 48%. In 2023, the revenue growth was almost 68%. So there is some magic which these guys are trying to work. So let's hand over to them to hear the system story and see what they have to tell about the numbers themselves. So over to you, guys.
Yes.
Thank you, Zubair. Rui, can you start?
Yes. Hello, everyone. Assalamu alaikum and good afternoon. As Sohail has mentioned, I'll just quickly take you through the brief presentation and then we'll keep more time for the Q&A. So starting off, this is the introductory slide for the people who are new here. Most of the people are familiar with System, but just quickly, I'll just quickly take you through that Systems has been was incorporated in 1977, and it's a true multinational originating out of Pakistan with our operations in 11 countries and our customer base in almost all the continents now. We are continuing to invest and to build our capabilities in digital data and AI and cloud computing, data analytics, automation. We have a few more slides later in the deck covering the use cases of data and AI. So now here on this slide, we can see the system's growth trajectory. Systems has been able to continue with the growth momentum that we have built over the years with 40% revenue CAGR in USD terms and around 63% revenue CAGR in PKR terms. And we have 36% EBITDA CAGR. Even despite of the, so Systems has a consistent policy of distributing about 20% of our earnings as dividends, which translates to about 6 rupees per share for this year as well. And despite of 100% bonus issue in 2021, the price bounced back and has been consistent. In terms of accolades and awards and recognitions, company has won various prestigious awards and accolades, and I've covered a few here. We have been recognized by Forbes Asia as one of the best under the billion for consecutive 4 years in a row, and also for the fastest growing company in the region. Microsoft has recognized us as country partner of the year for Pakistan and for UAE. And not just that, we have won an exclusive Inner Circle award, which is a testament of our exceptional solutions and delivery. Temenos is also recognized as MIA delivery partner of the year. And then Asia Money and PSX has been recognizing us among the top 25 companies for the last 3 years. Our collaborations with the industry partners, such as Microsoft, Temenos, SAP, IBM, Salesforce, and others have enabled us to offer cutting-edge solutions and services to our valued customers, enhancing our competitive edge. So I just go to this slide where we are showing our headcount dispersion. So over the years, our employee base has also become diversified, and that gives us two benefits. So it ensures business continuity from other regions if anything happens in case of any issue. And it also gives us a larger pool of skill sets and makes us more competitive. And in this way, we can also source rare skill set that are not available from Pakistan. We can get it from other regions. We are continuously investing to upskill and reskill our workforce for newer technology stacks and upcoming technologies like AI and Gen AI. We have collaborated with academia, and we are running multiple training programs to develop our human resources. And this is, if we have to segregate our investment priorities, then investment in resources and development of our human resources is one of our key priorities. So even with this geographical dispersion, we are still focused on offshoring, and our priority is to move most of the work offshore to Pakistan to get the cost advantage in the region. Now, with revenue contribution coming from NBC and BFS, our BFS vertical is the highest revenue contributor now at 29%. With telco being the second largest at 22%, followed by technology, retail, public sector, and other miscellaneous, including healthcare, pharma, manufacturing, education. In terms of margin, retail CBG takes the lead, as most of the customers from this sector are US-based, and the rates in the US and Europe markets are higher and better. For BFS, the reported margins, if you look at the segment note, the reported margins are lower because of the amortization cost of the country model bank that we had acquired rights from Temenos in 2022. So that dilutes our profitability. But if I normalize that, our GP is around 20% with 10% operating margin in BFS segment as well. So I'll just, in the essence of time, I just move to the direct financial performance. So here is this slide, benchmarking slide that we have prepared to show where systems stand as compared to these global tech giants. The size of the companies is, of course, much larger than systems, but you can see that systems margins are comparable. So these I have mentioned where the headquarters of these entities are. Infosys and TCS, you can see, have an advantage of huge economies of scale. And these two companies are primarily have US-based customers, so their margins are high. But an important point to note here is the PE ratios and the trading multiples of these entities as compared to systems. Moving on, this is our client composition, and on this slide, just want to highlight that our customer base is also very well diversified, like we are diversified in terms of industries. Our top customer is contributing only 13% to our revenue, and 49% of our revenue is well distributed among 20 customers. So the performance, revenue performance, and EBITDA performance I've covered in the summary slide, but so I will just take you to the major reasons for variance that I wanted to touch upon, which is impacting our, has put pressure on our margins. It's primarily the inflation, because when the average dollar rate in 2022 was 2.5, the average dollar rate for 2023 was 2.80. It does give us some advantage in the revenue. It does, but it puts pressure on the cost at the same time. So the inflationary pressures and change in the revenue mix is impacting our margins. Additionally, in 2022, most of our entities, subsidiaries, and NDC were not fully operational. So this 2023 was a full operational year for all the subsidiaries and for the acquisitions as well. So that is why there is a higher admin and marketing cost due to upfront investment in infrastructure and business development in these areas. And we have invested in high-skilled resources, which have been hired on site. In the other two important explanations that I wanted to touch upon is the one-off impairment adjustment, which is in the investment of Jomo, which we took in June. We covered it in our June investor briefing session as well, because the performance of the entity did not turn out to be what we expected. So we proactively charge it off in our June results. And now we have taken two more adjustments. So one is this share of loss that is coming from Jugnu. But this is actually just an offsetting adjustment. So Jugnu has the shareholding percentage, or the own shareholding from Jugnu has changed. And we had to recognize a one-off gain on this investment. And to adjust the value, we have brought it down and have recognized a corresponding loss on the same investment. So the gain comes here in other income, and the loss is shown as separate line item because of the accounting regulations. Similarly, there is a one-off impairment loss which we have recognized on EP Systems. EP Systems had a valuation of around 660 million rupees in our books. We had recognized a one-off notional gain in 2021 when our shareholding percent changed in the EP Systems and it moved from subsidiary to associate. So as per accounting standards, we had to record a huge notional gain on this investment back in 2021. So this loss adjustment is to just normalize that investment gain that we recognized, and it is notional. Again, there is no cash loss. The investment in cash is intact. Moving on to this currency mix slide, just wanted to highlight here that 95% of our revenue is in foreign currency, as compared to 60% of our cost is in local currency. So in economies like Pakistan, where 8 to 10% currency depreciation is a norm, we get this advantage here. I'll skip ESG. There is data which you can read and ask questions, and I will hand over to Asif to cover the way forward.
Okay. Good afternoon, everyone. Assalamu alaikum. Or wherever you are, it's good morning or good evening, depending on your time zone. Thank you, Rui, for covering up. So I think, as Rui said, we have a very strong momentum of growth over the last 5 years, and we are very confident based on the pipeline that what we have, based on the bookings that what we take into account for 2024. We have a strong pipeline of orders and bookings that we are very confident that we will continue that growth journey. Of course, there is as you can see from our previous analyst briefings as well as previous results, we are very heavily focused now on exports, and as the Rui slide suggested as well, even in a local country where we do domestic business, we try to cover ourselves through the dollar hedging. So that has worked very well over the past few years, and we truly believe there is definitely from exporter perspective, of course, it's good for the country. The dollar has appreciated 4 or 5% since June, but we are really fundamentally very strong from that perspective. Like, our business is like dollar hedged. and our cost, most of the cost is in PKR terms, like 60% or more. So we're we have changed our business model over last few years, and that has paved the way that we are more export oriented and more like we have a supply chain local and delivering to the world, which is the best model that we can have. So we from a pillar of like, of course, the pipeline, the booking is the most important critical pillar, which we have achieved last year for the future. Skills and service offering, of course, we're in a constant and continuously building, because last few years, or I would say last 2 years in specific, technology has shifted so rapidly. It has been like changing the world, changing the things that is operating, and challenging every human being on the earth who is trying to do, or every corporation, whether it's in developed markets or underdeveloped markets, everybody is challenged through the technology. So we are building the strong skills and service offerings according to the need of the market. And being diversified and in the portfolio and the verticals and the competency or horizontal in the technology offering, we believe that we have a huge advantage going forward. Again, like as we highlighted in the revenue categorization as well, now we are very focused approach. We have taken a very, very focused approach, not the spray paint approach that where we just going after anything and everything. Now we know that these are the banks in these regions we need to attack and target and bring them on board. These are the telcos that are operating. We need to somehow get into foot in the door through our offerings, through our delivery credibility, through our references. So we are really, and of course, public sector and the retail CPG, which Rui highlighted as well in the previous slides. We're now going at the precision approach where we know that our success rate for opening the new accounts is greater. And wherever we have those accounts, we are very strongly focused on, we call enhancing our revenue in the existing accounts, because there is a depth that's what we are building in each and every account. So our existing clients are growing, and we are able to on or close the new accounts, which is giving us the confidence that we can maintain the growth momentum that we have. Geographies and inorganic geographies, we have, as you guys have seen, we have opened so many geographies in the last 2 years at the similar time. What Rui was explaining, we have invested heavily as an OPEX in these markets, because when you open the markets, whoever is following systems, like earlier Middle East was not making money, right? For a couple of years, because we invested heavily, we built the base. Then now you can see the results, that how it has flourished. Now we are the momentum, we have the growth, we have the base, and now it's very profitable as well. So that's what we have done in the last 2 years. We have taken an approach where we have an aggressive growth mindset. We have opened these geographies. Now we're at that stage. We are consolidating in this year and next year. Now we've opened those attractive and lucrative markets like Saudi and UAE and APAC region. Now we are really focusing on double down and make sure that we achieve the result and the return on investment that what we have made in the last 2 years. So we're very confident. Wherever we went, I think we have gotten success in most of the areas, I would say. There are a few things that which are not performing. We constantly and continuously evaluate, and we follow the principle, whatever doesn't work, of course, we need to do something. So we are in the constant review process. And inorganic growth, again, but of course, we are not like just going after anything crazily. As I said, like we have a huge growth momentum that we really want to first exploit what we have, and exploring the new opportunities in these verticals, and especially in the AI area. I think we are seeing a strong momentum of all the clients that what we have is asking about what can we do and make a differential advantage in AI and data. And we are very strongly focused on that. So these are the key plans that what we have, and we will continue to work on that. Next, please. So investment priorities, I think it's very clear. we are a services organization. We believe in the talent. We are investing heavily in talent. We are building the bench. We are training a lot of people. We are building and investing in AI because that's the future. And definitely most of our investments will go in talent, new service offering, and strengthening or double down, as I said, current geographies, right? These are the core three priorities that what we will be continuing having because we see a huge opportunity ahead of us, especially in the region, because in the region we are recognized as one of the leading player. And when we go and sell that, because there is a huge gap, a strategic gap in the markets where we operate, especially in the region, GCC region. Like there are large Indian companies and there are smaller local companies. There is no one in the region like has even a presence like us, about close to 10,000 people, right? The closest that company that in the region in Egypt is 1,500 people. So we have emerged as a strong alternative for a lot of customers, and we are seeing a lot of people have been switching from these large organizations to a company like us. So it's a great we have been blessed and grateful that we were able to achieve that as unique positioning in the region, and that is attracting a lot of customers, a lot of references, and principals like Microsoft, Temenos, SAP, Salesforce. They are supporting us and they are bringing a lot of opportunities for us to perform and to get new clients and new business. So next.
That's all. So we can open the floor.
Love to answer any questions that anyone has, and please, Zubair, I think if you can, I'm assuming you have told people to how to ask the questions, right?
Basically, the format that we will be following is the questions Q&A. You can put it in the chat box, and we will take one by one and try to skip those questions that have been already answered or have been taken care for. So to start off with, please comment on the revenue outlook. It's a question from Muhammad Bilal Ahmed. Comment on the revenue outlook considering the decline in the dollarized revenue from the European region in 2024, and what was the reason for the decline?
2024, you're talking about 2024 Europe, of course.
2023. It's written 2024.
2023, I think there is a one-off a C loss. That's what, if you read our director report, even we put a note on it. There was a one-off C loss transaction that we have sold our corporate loan origination system to Temenos for close to $15 million. So that was a one-off recording of the revenue that we have done in Europe. It was not a business revenue, it was a one-off revenue. So we have grown Europe as well as compared to the last year, since there was a one-off revenue that is showing in accounting results, not a normalized result. So that is the one. So Europe looks, and for 2024, even Europe from the booking perspective, from the pipeline perspective, it is looking much stronger than 2023. Okay, so the next.
The second question from Bilal is, in fourth quarter 2022, there was a significant surge in the revenue from the European region. Can you please?
The same.
2022, I think he's maybe trying to refer to 2020.
It's the same question.
The question has already been answered.
Yeah.
Okay. Do you expect the revenue from European region to? I think that's already answered. There is a decline in retail and CPG segment in dollarized terms. Please comment on that.
Yeah, because most of the retail and CPG business that we get from Europe and America, in this part of the world, we have grown, and as I said, mostly in banking and telco in our region. Then the regional revenue is not much in retail and CPG. So Europe and America revenue from retail and CPG was a little down. That's why it is reflected. And we are not selling aggressively in our region, means GCC region does not have an appetite for retail and CPG that much, at least retail.
Systems long-term dollarized sales growth has been an average of 20%. what is your outlook on the dollarized growth rate going forward? You always
think
laugh at this question.
Yeah, I think it is not 20%. If you look at the CAGR, which Zubair has said, it is more than that. It's about more than 30%, 34% CAGR in the dollar terms as well. Last year, even it was normalized growth. If we take one off, is more than 35, close to 35% dollar terms. So definitely, as I indicated, that I can't comment on exact percentage, but based on the booking and based on the pipeline that what we are very confident they will continue the growth momentum.
USD cost component has increased significantly in CY23. Can you please outline the reason and what is the future outlook for costs? Does the company foresee a further increase? Can we expect this component to increase up to 50% in the coming years? I think this may only because of foreign hirings, but please comment on that.
Yeah, it's a foreign hiring as well. And while our entities in Middle East and Africa are growing, we are hiring the local people as well. It's an on-site and offshore mix. Now the services that we are offering into these markets, client wants people to be on-site as well because of certain regulations, certain restrictions on the data access, and so on and so forth. So this, as we grow, the cost will grow as well. It's a directly proportional. It's not 100% directly proportional, but of course, it can't be like that we keep growing in dollar terms and there is a dollarized cost doesn't go up. So it will go up, but of course, not directly proportional, 100%, I would say.
And Asif, if you would also like to add on this, there's a certain understanding that usually in the markets that you used to cover before, where the primary focus of the revenue were English-speaking markets. Now you're mostly focused on the GCC markets. So I think you probably need to hire separately Arabic-speaking people to.
We have hired. It's not just Arabic-speaking people. You need to hire. Now we are a global company. We don't. Of course, we are proud of Pakistani company and we sell Pakistan from heart and soul. But when we position ourselves, we are a global company, right? When you're a global company, then you have to have mix of all the diversity needs to be there. You can't just have one nationality and figure out. So language is one, but of course, from a culture perspective, from a diversification perspective, you need all diversity, right? So that's why we are having that. And we will continue to do that approach from gender diversity to nationality diversity. And of course,
so how would you like to respond to this? Can we expect this component to increase up to 50% in the coming years so that people have an idea of what quantum the foreign hirees would be in the cost structure?
Most of our growth will come. Our business focus is, of course, growing offshore business because offshore business is more profitable and it put less strain on the cash flow as well. But of course, I can't give you exact percentage, but foreign hiring, as I said, if you add $1, it doesn't mean that the dollar cost will be increased directly as well. But there is a component of dollar, whether it's a 50 cents on $1 will be increased on site as well, right? Because you need to invest rightly into the resources and on site as well as you are growing. But most of our needs to be directionally offshore driven. That's what we want. That's what we would like to. That's what we are pushing, right? So
in the last quarter, there is a dip in quarterly gross margin. Any specific reason for that?
I think it's a very natural one is natural, right? Like what happened is that you plan something, right? Based on assumptions, right? When we were in June, the dollar was 288, right? Or 287 point something. So we planned the further investment looking at dollar will like 5 to 8% depreciate further in the upcoming 12 months. So we invested in HR, we invested in markets, we planned, budgeted, forecasted, projected like this. But in turn, right, what happens is the cost has been planned like this, considering these assumptions, and dollar has appreciated 4% in the last quarter, 3 to 4% since June. So of course, so there is a gap in the assumption. We were expecting 5% depreciation versus 3%, 4% depreciation, so 8, 9% gap came in, which was not natural considering what Pakistan's situation typically is. We plan typical way. So that is unusual for us to, so the cost has been committed. And of course, I will tell you in the first quarter is almost over. That's a similar situation. The dollar is further appreciated, right? So, but we are very confident our model is great. Like we can't go wrong when our revenue is hedged with the dollars, right? It's fine if it is temporarily our margins are depressed because of currency appreciation. It's perfectly fine. Because in the longer run, I think we are more secure because that's an export-based business. Dollar is going to continue traditionally 5 to 8%. Depreciation is normal, and if one year it is an appreciation, that's okay.
Usually we have almost dollar devaluation in the range of 6 to 7% over the course of last 20 years.
Yeah, so 5 to 8% was the right assumption.
Yeah, so it should normalize.
Yeah, it should normalize. And if it is not, then it's okay. It's for 1 year, a few quarters here and there.
So just for the sake of broader understanding, so you mentioned first quarter, you expect the similar situation to continue.
Because dollar rate is the same. You guys know the dollar rate today, right? So
yeah. So see, we were looking at these margins. So if you could now the real reason of everybody asking this question is that they want to get a flavor on the margins that you anticipate. So
there are 2-3 things I would like to add on margin since you are asking. One is, of course, it is tied up to the dollar. Of course, if dollar depreciate even a little bit, our margins go directly proportional because it's most of our standalone revenue is dollar based now, right? So even one rupee increase creates a good amount of revenue and profit growth, even 1 rupee increase, right? Similarly, 1 rupee decrease also creates some impact as well. So it's both ways. So, and on the other side, as I said, like we have invested considering that now we have already invested. Now we are taking a measure, we are solidifying and double down, as I said, wherever we have invested. So we are not like, we're now planning it accordingly. So now we change the plan as well. Like when things are changed and the economy has changed, you have to change your plan a little bit as well, alter. It doesn't mean that we stop growing. We will continue growing, but we tailored certain cost elements. We made certain decisions, which can take us back to the better margin path. So we are definitely, and of course, in inflationary environment, you have to adjust the salaries as well year on year. It's very natural, right? It's not unnatural. You can't just not adjust your employees' salaries, they will leave, right? So we have to retain good people, and that's we are in business. So I'm very confident we have managed that as well from the inflationary pressure, also from the dollar pressure. We have changed our elements, planning strategy, and we are going for the efficiency, more efficiency. And I think it's a great thing that happens sometimes, that these unknown things happen and you just think differently as a leadership and as a management. Everybody's thinking differently, and we are very positive that now through efficiency, if we can increase our base with this dollar rate, I think then the future is bright for sure, right? Because the margins will automatically improve and that dollar will go to this normal course of 5 to 8% devaluation. So we are not like just relying on dollars to fix. We are trying to bring more and more efficiency and making correct decisions and planning decisions, which we based on certain assumptions. Now we have changed our assumptions and we made the decisions accordingly. So we're confident it will be much better in upcoming quarters.
Okay, the next question is from Kasim Nadeem. Generative AI is a big future market, but skill set required is not there in Pakistan yet. I see a dilemma here for Systems Limited. How are you planning to upskill existing talent and fill this gap?
That's why we are leading that. We know these issues and challenges. We address those through training, upskilling, reskilling our existing resources. We have talented people. AI and Gen AI is not a rocket science for data people to learn because they have the brighter concepts. And we have started upskilling and reskilling our own people inside the company. And of course, we are hiring as well. And what Rui shared the slide, now we are in different countries. Now the world is open, like the world export is open for us, import of talent is open as well. So if we can get one or two great guys, they can train 20, 30 people in Pakistan. So we're creating those skill set. Of course, there is a challenge. It's not generative AI. There is a challenge in every skill that Pakistan, of course, we have never bogged down on that. We just continuously produce more, right? And that's what we truly believe. You have to be a production house versus just waiting for someone to say that there is a shortage. So far, I think we are covered. And if we see more demand, we will really focus more on training more people.
Okay. There are a few other questions related to AI. How can we expect the revenue to growth in both foreign and local operations through AI offerings? Where are your AI business more focused on, local or foreign? So if you can then respond to them collectively.
Sorry, what did you say?
It's basically how can we expect the revenue to grow in both foreign and local operations through AI offerings? Where are your AI business more focused? I think it's more focused on foreign. That's the national composition of your business. I think let's move forward. Are there any other issues, HR issues of any type that the company is facing? Moreover, with growing remote opportunity, does management foresee any issue going forward to retain talent?
That's an ongoing business, right? That's ongoing. That's
Sorry,
ongoing.
Asif, I will club another question with it. So how big a challenge is employee retention right now? So you can answer both. Number of employees are increasing on net basis. On a gross level, how big will the hiring requirement be? Are your manpower requirements in terms of quality and training met by Pakistani graduates? And if you can also highlight the headcount at the close of the calendar year, and how many employees do you intend to hire in this current calendar year?
Yeah, first of all, I think the people, definitely there is a turnover everywhere, not just IT, but if in your field, if you are in a capital market, there are a lot of fund managers even moving, a lot of accountants moving out. So of course, there will be a turnover. We expect that. And we are building that in our plan to create the bench. That's what I was sharing earlier. That's a bench planning that what we do, because we know that there will be people all like 15 to 20% turnover will be there. No matter how good we pay, how good we do, there are always people, there's always opportunity abroad. So we have to be prepared. So that's a continuous process. It's not one-off. For us, it is routine. So we will definitely hire more than people leave. I can't tell you like how many, because that will itself saying that how much growth we are going to have. You can have a multiplier effect later on. So yes, we will have a net addition every month. There is a greater net addition into the company because of the new business and the growth opportunities that we get. So we'll continue to add. And of course, at the end of the year, I'm sure very positive that we will have greater net addition into the resource mix as well.
Regionally, we've been seeing that many of these regional tech companies have been laying off employees. Some are facing the brunt of maybe slowdown or what. So you confident enough that you'll be able to maintain the addition path, or you think that what is impacting them will sooner or later grip you as well?
I think you have to see what kind of people they lay off. They have a bigness problem. They are big, right? So they have different problem, bigness problem, right? So what bigness problem is, because they have hired so many low-end employees as well, which they couldn't make them billable or which they couldn't make them productive, right? So they hired too many in the growth path. And since they grew crazily from numbers perspective, so they need to lay off and shed off certain routine employees, but they are not laying off the key employees of like any key employees or the latest technology. Nobody is laying off because it's a huge demand. It's a shortage, right? So that's why we are getting work. and outsourcing in Pakistan or other part of the world because there is a scarcity of those resources, right? So that's what I'm saying. I was saying earlier as well. The world has changed, and this last 2-3 years has been transformational from technology. So if you don't upgrade or upskill yourself as an individual, no matter which field you are going to be redundant, right? It doesn't mean that AI or anything will take your job, but you have to constantly challenge yourself, upskill and reskill, and learn new things. You can't have the similar mindset and just go on. So
Sure.
we truly believe in that.
Okay, now this is a good question from Syed Hassan Raza, Maple Leaf Capital. Your total revenue in the Middle Eastern region reached almost $100 million, reflecting a Y-on-Y increase of nearly 75%. Do you anticipate these growth levels to continue? In Pakistan region, you experienced a loss at the gross level in fourth quarter. Yes, and what was the reason behind this?
Yeah, first question is, yeah, of course, 75% growth in a percentage term is definitely, nobody can just say that every year it can be like that. But yes, our growth momentum in these regions are there, and we are seeing the growth over year. So that is certain, right? That is certain. It's not one of a growth that I can answer. It's a sustainable growth, right? So percentage, of course, I can't quote, but it's a sustainable growth. It doesn't mean that it happens in 1 year and next year we will fall off because it was one of 75% growth. It's not one of 75% growth. It is a sustainable business growth. The second question on the domestic market, yes, domestic market. As you can see, our business, we are shrinking as well. So we're exiting from smaller contracts and so on and so forth. We are closing off public sector project. We are not signing new public sector and so on and so forth. And because we take a lot of IFRS 9, we follow religiously from collection perspective, and when the GDP is negative and the growth is negative, and the macroeconomic perspective, IFRS 9 model works little aggressively and let us provide more provision than actual provisions, right? So that was one of the reason, and there were few old projects that were what we were doing, they were in red. We need to finish those. So we're expecting these old projects will finish by second quarter of this year, and we will have most of the revenue will be the newer revenue, which we have signed up with the better rates and better contracts. So we will see the good improvement in domestic business, not in terms of the value, because we are not deliberately growing too much. We want to be really focused on export. But it doesn't mean that we want to leave any good business on the table as well. So, but as I said earlier, we are very focused on the vertical-based approach. So we're not going after the verticals which are going to bleed or which are very low in margins. We're going after the verticals which have the margins, which have the opportunities, and which we can replicate for the export markets, where we can train the talent on the local market and export that talent. So we are now changed our approach, which was till last year, we were growing in every direction. Now we're very focused on where we need to grow and make profits. That's how we will improve overall profits, because if we want to maintain the current dollar rate and still improve the margins ongoing basis, we need to plug in all those gaps.
Okay, USD revenue dropped by 4% Y-on-Y in both America and Europe. How do you foresee these regions going forward?
From the pipeline and from the booking perspective, we see both of them will grow this year. Definitely, I'm very positive because we have seen the last quarter and last quarter numbers in those geographies, and this quarter looking great from that perspective as well. So we see that these two geographies will also post the growth momentum going forward in dollar terms. Rupees term, of course, it was growing, but in dollar terms as well. Now the rupee and dollar is constant for a couple of quarters, so it doesn't matter, right?
In terms of potential, if I were to ask you, I think that probably I was told by somebody, I wouldn't go into the details, but I'm hearing that now is the time that systems is getting leads from the ERP originators themselves, like Microsoft or SAP. Uh, they have gotten or reached a level of confidence with you guys that they are basically referring clients to systems in the Middle Eastern region. How true that is, and if you can shed some more light on that.
Yeah, definitely. This is the main growth engine, right? The growth we are receiving is major contribution is because of that. We have built the relationship with these channels and principals. So it's not like, of course, we have our own sales team, but majority of the leads and opportunities come from these principals. And once these opportunities and leads comes from principal, it means it is qualified and it is referred by the principal. So it gives a confidence to a customer. If principal is saying these are one of two top three partners that we are bringing up front for you to implement certain technology, it gives a confidence to customers. So your win ratio is greater than 33% in any case, right? So we compete with three partners with the cost advantage that what we have in Pakistan, which no one else has, and in the world, I would say. So we with the passion and the quality and the cost, right? So I would say like first quality over the larger companies, better quality over the larger country at the cost effectiveness and with the agility and nimbleness we bring.
So where have you received referrals from principals? If you can highlight the regions. Is the Saudi, as you can see, the Saudi market is now contributing big time. So has Saudi received referrals from principals that have helped
How
you
did you
really
say?
grow?
How did you say that Saudi has not contributed? Saudi has done great.
No, I'm saying that Saudi has done great. So is the referrals a great reason behind that growth, that the principal referrals that have come through has led you
It's
to scale up in
both.
Saudi?
Yes, principal definitely, and our sales team and our leadership team, they have performed phenomenally well, and they captured any opportunity that come on the table. We went for the marketing events as well. We have attended so many events over there. We participated in those events, generated those leads organically as well, and since we have now similar customer references, it really helps. When you're saying, I've done this work in Dubai or Qatar or somewhere, then Saudi customer gets automatically confidence that we have experience in the region and we have done the similar work in the other region. So that is one of the reason, one of the main catalysts in going and achieving the success in the newer markets because of the credentials that we have developed over last 5 years, which has created a multiplier effect.
Okay, systems investment in Pakistani startups are turning out to be cash burning pain points. What are we missing here?
As a country, actually, we are missing, right? So at one point, you know that we have received in 2021-22 timeframe, $650 million from foreign investors. Everybody has a FOMO, right? That Pakistan startup ecosystem will be like Indonesia and we must be investing. And everyone was like raising the money on PowerPoints even, right? And if they were burning the cash startup, people were putting more money onto it, right? So because it was we copied pasted the Western model that it works in Pakistan. Unfortunately, that bubble has burst with this economic crisis, with the dollar devaluation, with the lack of predictability and stability. The investors have gone away from the startup ecosystem for the time being. As we are seeing the improvement in the economy, as we are seeing the investor confidence getting back, it will come back. But right now, last 2 years was very difficult for most of the startups. And when startups have been on the burning model of cash and on the growth path, it's very hard to just put a break, immediately scratch halt and just continue the business as well. It doesn't work. And the investment didn't come, investment dried out. So we did not want to invest further because we thought that it would be burning more cash onto these risks while we focus on our core business and invest in the core business where we see a multiplier effect, where we see a return on investment guaranteed return of investment versus maybe a good return on investment. That's a risky proposition. It's a good proposition. I'm not saying it's a bad strategy. At that time, it was a good strategy because everyone was doing it. We did a very careful approach, not did too many as well, but did few. One is still working. I think Jugnu has gone, but our sales flow investment is phenomenal. Actually, they are doing phenomenally well. Our book is actually off that investment. We have written off everything because of that, but the company is doing well, very well. So our investment, whenever we exit, we will get the return for sure. But other investments, of course, didn't work out and that's why we are not aggressively now investing in any. You have not seen any new investment in 2023, and we don't have aggressive plan as well. If we get a great opportunity, we never say no. But right now there is no aggressive plan like we had in 2022. I would admit that we were also thinking that this FOMO thing, right? So I think now we're very careful and we are putting every penny on our core business.
Okay. When systems aim to develop proprietary software applications in the near future, we see other global companies like systems which develop their own software fetch much higher revenue per employee and gross margins.
We do a lot. Otherwise, we can't win business. That's why vertical approach, if I explained to you earlier as well, in BFS, we have all these accelerators or proprietary solutions, products that we go and present to customers and we get foot in the door. Yeah, we're not running SaaS-based model right now, but for services business, very important that you have these innovations, right? And if you can't, then you will be one of those system integrator, right? We don't want to be one of those system integrators. We want to be the problem solver and solution oriented company and to give the ROI based solutions, right? Bottom line first type of an approach versus traditional body selling or traditional system integration approach. So we show the customer what is bottom line, their bottom line through the solution and through innovation. So bottom line first and ROI based solutioning approach and a solution mindset versus just the traditional approach. So we have in those verticals where we are strong.
Please share the impact of ERF now linked to the policy rate. Will this force the company to liquidate more of its dollars?
Yeah, that's why I said we made certain assumptions and it didn't work out, right? It worked out for longer period when the dollar was devaluing. But for now, of course, if you will see the considerable drop in our ERF, we have paid off significant amount of money into ERF, and will hopefully pay off remaining as well. We know we have to, as I said, we have to change certain assumption in the strategy as things move along. So we have made those adjustments, and our finance cost will be lesser going forward.
Okay. I think most of
there are a few questions around dividend rate and return on the shareholders. Maybe
I
after
think you've already answered at the start that
the growth companies even don't pay dividend, right? So if you look at the IT companies, which we compare in the benchmark analysis, nobody pays any dividend, right, for longer period of time because we all focus on growth, right? We reinvest the money. We don't get the money from banks. As you asked the question, like ERF payoff and finance cost is increasing. There is other solution is debt or use your own profits, right, to grow. So the debt is expensive. You just asked this question. So we really need to invest the money on growth, really reinvesting on the growth. And that's why you are seeing that 65% CAGR since last 5 years. We are not borrowing, we are not raising equity investment and so on and so forth for that purpose, right? So debt or equity we are not taking. So we are very secure. We are running from our own cash flows, right? So we still maintain, I think, the generous dividend policy for 20%. Which we have been following. IT companies don't have these generous, the growth companies, I would say, have these generous dividend policy as we have.
Well, all of us have been witnessing the turmoil in the Middle Eastern region. So far, there are pretty much of fancy statements coming from the Saudi government also, Vision 2030 also, and The UAE also literally seems like it is unfazed. But there is a possibility of this spreading out to the region. How concerned are you regarding that? Because a lot of this growth is coming from the Middle Eastern region, and how quickly and how agile you would be uh, in turning off these resources to other regions where required. Just on your thoughts on that, broad thoughts.
I think, to be honest, I don't know what turmoil you're talking about. Saudi does not have any turmoil. They have different plans, right? They are like investing $40 billion in AI and all these big investments going on. The PIF is spending money like us, like no tomorrow, right? So things, they are investing money into IT, and 2030, the World Cup, the Expo, these things are lined up. So I don't see in Saudi there's a turmoil from that perspective, and people are coming. I was in the Leap, like it was unbelievable success. It was like a crazy, like it is a FOMO in Riyadh as well, right? So everybody wants to be there, right? Every company wants to be there. And so I don't see turmoil. Yeah, if anything happens, which is unforeseen, no one has a crystal ball from that perspective. So deploying
Agreed.
those resources, we are very confident. We have US and Europe. We will shift focus on US and Europe, and then we will figure out a way. If there is a turmoil and everything closes, then a lot of businesses will have an impact, right? It's not just IT companies. But I don't see that coming because of the planning. What you go and see in Saudi and Dubai, they're in a different zone right now. They're in a different.
So in which year are you seeing Saudi turning out to be $100 million business?
It's in near future, I can say.
So that is a lot about the confidence you have in that market.
Yeah, definitely. It's everybody has a confidence. Something happened which you don't have a crystal ball. That we can, again, as I said, you can make certain assumption and planning assumption in business, right? So looking at the situation, you make the business decision with what Saudis are doing right now. As I said, $40 billion like in AI. It's just an announcement. Even if they invest 4 billion, it's a lot of money, right? So it's these things give you the confidence as well. They are not going backwards, they are going forward, and they need to upgrade themselves, their youth, their skill set. They're working on it, and the young generation coming in, they're all focused on savvy on IT. All the businesses are really competing on that IT space. All the banks want to do more in digital space. All the telcos are offering digital services right now. So you don't see that turmoil on the ground. I don't know.
Okay.
I don't know otherwise, right?
I was just trying to hear you out on that. I think mostly we have covered. If there are any questions, Rohi, that you think are left out or I have just flag out. One last thing, sure, please.
Yeah, there's a question around comparative advantage of Egypt-based employees. Have you addressed it,
Yeah.
Asif?
No. This left out. What are the competitive advantages of Egypt-based employees which we don't get from Pakistani employees? How are the compensation is different from other employees if they are?
Egypt is slightly expensive than Pakistan, like I would say about 15 to 20% roughly from Pakistan. But what we get is the language. What we get is the diversity. What we get is the different resource pool, different markets, so different resource pool. So if say, for example, we are hiring 10 people in Pakistan, we open the requisition in both places. So we can always find the good people, right? So that's how, if you read our direct report, we are saying we will build more supply markets now versus demand markets, right? So now the approach has changed because we see a growth in our current investment, what we have made in the market, the growth is there. So now we need to invest in the supply markets in the other markets like Morocco to Uzbekistan to there are many other geographies where there is a IT talent where we need to tap in. And luckily, I would say Egypt, we went with the intention of having a supply market for our delivery, but we got a lot of business in Egypt as well, which was a surprise for us as well. So that entity is already cash flow positive by having its own business in Egypt, like local business, right? From the telcos and from the banks. And we were not expecting or we didn't plan for that either, right? Because Egypt, we were always considering as a supply center. So wherever we go, I think with our model and the mix, I think we can, any market we can turn into the demand and supply market as well. We have that kind of edge from Pakistan, which we can have a blended model and it works.
I think mostly it has been attended. One last question that would be from my side, or rather a leading question. There is too much talk around tech parks in Pakistan, too much talks around SIFC focusing on IT or mining, agriculture. So you being relevant to IT, are you actually seeing something on the ground, or it's all just lip service? And secondly, what's around working around the tech parks? Is it happening, and how do, how do you see them shaping up the tech landscape of the country?
First of all, these tech parks are very important for the country because seeing is believing and showing is believing as well. When the investor comes in or when the client comes in, they see the big IT park and the security as a service. They see a very secure environment. They see big buildings, big companies, young talent roaming around. You know, it gives immense confidence. Like we built a campus in Lahore, and when we take our now clients to Lahore and Karachi offices, their mind blew off. They even don't have expectation from Pakistan that Pakistan will have that world-class infrastructure they see in our neighboring countries, right? So that is very super important. I've been stressing this point forever to the government. And finally, if you are seeing that news and it's going to happen, which I think there is a focus, definitely, and there are projects announced, there are projects in works, and they're listening to us, I think that will definitely shape the IT landscape, number one. Number two, this STZA, which the act and law has been passed. If virtual STZA comes and we get IT companies get all these benefits, what STZA offers, it will be an immense boost for the IT companies, from the cost saving perspective, and for the foreign companies to come and open their offices in STZ and get those and reap those benefits. So that is great. I think from SIFC perspective, you asked the question. I think everyone, it's just SIFC government or even private public partnership like companies like us and individuals like us. Everyone contributes into this is not enough. We all have to do more. So whoever comes, they're more than welcome to do. And it's sometimes we need most of the time, I think the positive branding and the messaging takes most of the brunt, right? So if we do that, that solves a lot of problem. I think we all need to build our country image and the brand. Why Pakistan in IT? And everyone needs to chip in. So we should not outsource this responsibility to SIFC or IT ministry. We all have to do it, and we are doing it. And I think with these involvement and interventions, it will definitely improve. I don't see any doubt that it will go down. It will definitely help and improve.
Okay, I think that's mostly done. I hope I'm not leaving out anything. So on this note, I would like to conclude this detailed presentation from the management of Systems Limited. I would like to thank all the attendees on behalf of Inside Securities. And we would love to have any questions, any further questions that you may have from the management, and we can get back to you on those. So please feel free to reach out at info@insidesec.com.pk with any subsequent questions you may have. And thank you so much, Tahir, for coordinating this. Thank you, Ruhi, for such an enlightening presentation. And as always, Mr. Asif Peet, thank you so much for answering the questions in such detail. We look forward to hosting you again. And I think that's all from this investor briefing session. Stay blessed, and I look forward to seeing you again. Thank you.
Thank you. Thank you, everyone. Thank you, everyone.
Thank you.